Let me tell you about the stupidest mistake young people make with money. It's not spending too much, though they do that. It's not earning too little, though most don't earn enough. The real mistake is this: they confuse motion with progress. They think because they're working hard, sweating, climbing some corporate ladder that they're building wealth. They're not. They're just busy. I learned this the hard way coming up during the Depression. My family lost everything. Not because we were lazy, not because we lacked ambition. We lost it because we didn't understand the fundamental difference between selling your time and owning capital. Labor pays you once. Capital pays you forever. Until you grasp that distinction, you're just another ox pulling a cart. Here's the inversion that most people never figure out. Don't ask yourself, how do I get rich? That's the wrong question. Ask this instead: what keeps intelligent people poor? Answer that, and you've solved the puzzle. Because wealth isn't about genius moves. It's about not making the catastrophically stupid ones. The mathematics of compounding are brutally simple. They're also brutally ignored. Take $100,000 earning 10% annually. In 10 years, that's $260,000. In 20 years, it's $673,000. In 30 years, you're looking at $1.7 million. Same money, same rate, just patience. But here's what nobody tells you about those neat little charts. Compound interest is absolutely useless if you don't have the discipline to let it work. I watched brilliant men during the 1,970 seconds inflation destroy themselves. They had the capital, they had the brains, but they lacked the temperament to sit still while their purchasing power appeared to erode. So they jumped into gold, into commodities, into all kinds of schemes. They confused activity with wisdom. The ones who got rich were the ones who did nothing stupid, not the ones who did something brilliant. Benjamin Franklin understood this 3 centuries ago. He wrote, "A penny saved is a penny earned." Simple words, but most people never decode what he meant. He wasn't talking about being cheap. He was talking about opportunity cost. Every dollar you spend today is a dollar that can't compound tomorrow. That's not frugality. That's mathematics. The cost of a fancy dinner isn't $30. It's what that $30 could become in 30 years. Now let me tell you why most people never accumulate that first critical mass of capital. It's not because they're stupid. It's because they're human. And humans come equipped with psychological tendencies that are absolutely poisonous to wealth building. I spent decades studying what I call the psychology of human misjudgment. 25 tendencies that cause even smart people to act like fools. 3 of them destroy more wealth than all the others combined. First, there's social proof tendency. You see your neighbor buy a new truck, so you need a new truck. Your coworker goes to Cancun, so you book a trip you can't afford. You're not making decisions, you're mimicking the herd. And mimicking the herd invites regression to the mean. If everyone around you is broke and you copy them, guess what you'll be? Second, there's envy and jealousy tendency. Warren Buffett calls this one of the most destructive emotions in finance. You don't just want to get ahead. You want to get ahead of Tom or Susan or whoever happens to be doing better than you. So you overspend to signal status. You buy the car, the watch, the house in the right neighborhood, all to impress people you don't even like. It's insane, but everyone does it. Third, and this one's deadly, deprival superreaction tendency. The moment you start saving, something breaks. The car, the roof, the water heater. And you feel like you're being deprived of your savings. So you raid the account. You tell yourself it's an emergency. But really, you just can't stand the psychological pain of not spending. That tendency alone keeps more people poor than anything else I've ever observed. These aren't moral failures. They're hardwired into your brain. Evolution didn't design you to sit on capital for 30 years. It designed you to survive the winter, impress a mate, and keep up with your tribe. Those instincts worked great on the savannah. They're catastrophic in modern finance. If you want to build wealth, you need to recognize these tendencies and systematically counteract them. Here's how inversion thinking helps. I borrowed this from the German mathematician Carl Gustav Jacobi, who said, invert. When I look at money problems, I don't ask how to get rich. I ask, what makes people go broke? Then I avoid those things. It's shockingly effective. What makes people go broke? Debt on depreciating assets, lifestyle inflation, chasing status, overconfidence in hot stocks. borrowing to invest, panic selling during crashes. All of it stems from the same source, an inability to sit still and do nothing. The hardest thing in investing and in life is to sit on your ass and wait. Most people can't do it. Their psychological need for activity overwhelms their rational mind. I've watched this play out for 70 years. The people who got wealthy weren't the smartest. They weren't the hardest workers. They were the ones with the temperament to save money, invested in simple index funds or good businesses, and then leave it alone for decades. That's it. No secret formula. No magic. Just the emotional discipline to avoid being stupid. Let me give you a concrete example. In 1972, I made one of my worst investment mistakes. I bought into a financial scheme that looked brilliant on paper. The math worked. The people involved were smart. But I hadn't asked the key question, what could go wrong? I was showing off, trying to prove I was clever. I lost a chunk of money. Not enough to ruin me, but enough to teach me a lesson I never forgot. Warren and I built Berkshire Hathaway by avoiding catastrophic mistakes more than by making brilliant decisions. We didn't buy See's Candies because it was exciting. We bought it because the math made sense, the business was simple enough to understand, and we weren't likely to lose our shirts. That's circle of competence thinking. Stay inside what you understand. Don't wander into territory where you're guessing. Most people do the opposite. They hear about crypto or tech stocks or some new trend, and they dive in head first. They don't understand the business. They don't know the risks. They just know it's going up, and they feel stupid for missing out. That's social proof tendency and envy combining into what I call a Lollapalooza effect. Multiple psychological biases reinforcing each other. It's almost impossible to resist unless you've trained yourself to recognize it. The solution is boring. Build capital by spending less than you earn. Invest it in things you understand. Businesses with durable competitive advantages, low costs, high returns on capital. Then sit on your hands for 20 years. Don't trade. Don't speculate. Don't try to outsmart the market. Just avoid being an idiot, and the math will do the rest. Now let's talk about the war of attrition that is capital formation. This isn't a sprint, it's a siege. And most people give up before the walls crack. I see young people today, they want results instantly. They think because they saved $5,000, they deserve to see it double in a year. That's not how it works. The first 100,000 takes forever. The second 100,000 takes half that time. By the time you've got 1,000,000, the next 1,000,000 comes faster than you can believe. Why? Because of the absolute power of compounding. But compounding requires time, and time requires patience, and patience is the scarcest resource in modern life. Everyone wants the results without the process. They read about Warren Buffett being worth $100 billion, but they ignore the fact that he started investing at age 11 and didn't hit his first billion until his 50s. That's 70 years of compounding. You can't hack that. I see people constantly trying to shortcut the process. They buy lottery tickets, gamble on options, day trade, chase penny stocks. They're not investing, they're gambling. And gambling is just a tax on people who can't do math. The house always wins. In the stock market, the house is the broker, the tax man, and your own emotional stupidity. You're better off buying an index fund and going fishing for 30 years. Here's the dirty secret about wealth. It's mostly waiting. You save money. You invest it. Then you do nothing. For years, maybe decades. You watch it grow slowly, painfully, invisibly. And every year you're tempted to do something. Sell, trade, rebalance, chase performance. The ones who get rich are the ones who resist that temptation. They understand that inactivity is a competitive advantage. I used to tell my law clients, the best investment advice I can give you is to be incredibly patient, skeptical. Patient because compounding takes time. Skeptical because the world is full of people trying to separate you from your money. Brokers, advisors, fund managers, all of them have an incentive to churn your account. Their wealth comes from your activity. Your wealth comes from doing nothing. Let me make this concrete. Suppose you're 25 years old. You earn $50,000 a year. You manage to save $10,000 of that. That's remarkable discipline, by the way. Most people can't do it. You invest that $10,000 in a boring index fund earning 10%. You do this every year for 40 years. At 65, you'll have $4.7 million. Not because you're smart, because you were disciplined and patient. Now suppose your buddy does the same thing, but he panics during the inevitable crashes. He sells in 2008. He pulls out in 2020. He trades when he gets bored. His returns drop to 7%. Same contributions, worse behavior. At 65, he's got $2 million. He lost $2.7 million because he couldn't sit still. That's the cost of stupidity. Not the obvious stupidity of buying junk. The subtle stupidity of not being able to endure boredom. This is why I always say temperament matters more than intelligence. I've met Nobel Prize winners who can't manage their own money. They're brilliant in their field, but they lack the emotional discipline to watch their portfolio do nothing for years. They need action, excitement, proof that they're smart. So they trade, speculate, and ultimately underperform a simple index fund that a child could manage. The key insight is this: wealth building is an endurance contest disguised as an intelligence test. The intelligent ones figure this out early. They realize the game is won by not losing, not by making brilliant moves. Every catastrophic mistake you avoid is a compounding advantage over everyone else who makes it. And trust me, most people make those mistakes repeatedly. Let me tell you about leverage, because this is where a lot of smart people destroy themselves. Leverage is borrowing money to invest. It seems like a shortcut. If you can make 10% on your own money, why not borrow at 5% and pocket the spread? I'll tell you why. Because markets don't move in straight lines, they crash. And when they do, leverage kills you. I watched this in 1987 and 2000 and 2008. Brilliant men, PhDs in mathematics, decades of experience, wiped out in weeks. Why? They used leverage. They were so confident in their models that they bet borrowed money. Then the market did what markets do. It behaved irrationally longer than they could stay solvent. Leverage doesn't just amplify returns. It amplifies stupidity, and everyone eventually does something stupid. If you're leveraged when it happens, you're finished. The correct amount of leverage for most people is zero, none. If you can't build wealth without borrowing, you don't understand the game. Warren and I never used meaningful leverage at Berkshire. We didn't need to. Patience and selectivity were our leverage. We'd wait years for the right opportunity, then deploy capital when others were panicking. That's real leverage, having capital when everyone else is broke and terrified. Here's another principle I learned from Ben Graham: margin of safety. Never cut it close. If you think a stock is worth 100, don't pay 95. Pay 70. That way, if you're wrong, and you will be wrong sometimes, you don't get killed. The same applies to personal finance. If you think you can save 10% of your income, target 20. If you think you can live on 50,000, budget for 40. Build buffers. Life will throw chaos at you. The buffer is what keeps you in the game. Most people do the opposite. They live right up to their means. They borrow up to their limit. They assume everything will go perfectly. Then something breaks, someone gets sick, the economy tanks, and they're underwater. That's not bad luck. That's bad planning. If you want to build wealth, you need to be paranoid. Assume things will go wrong. Then structure your life so you survive anyway. I came of age during the Depression. I watched good men lose everything because they had no margin. They over-leveraged. They trusted in permanent prosperity. When the crash came, they were finished. The lesson I learned was simple: be prepared for disaster. Not because you're pessimistic, because you're rational. Markets crash, recessions happen, jobs disappear. The people who survive are the ones who planned for it. Now let's address the psychological torture of small numbers. This is where most people quit. You save $1,000. You invest it. A year later, it's worth $1,100. You made $100. Big deal. You can't even buy groceries with that. So you pull it out and blow it on something stupid. You just killed compounding before it could breathe. I understand the frustration. In the beginning, the numbers are insulting. But here's what you need to understand. Those small numbers are the foundation. You're not building wealth in year one. You're building the habit. You're training your brain to delay gratification. You're proving to yourself that you can resist the psychological pull to spend. That's more valuable than the $100 you earned. The magic of compounding doesn't reveal itself for a decade, maybe two. You have to endure the boring years before you reach the exciting years. Most people can't do it. They look at their pathetic little balance and think, this is pointless. Then they quit, and 20 years later they're broke, wondering what happened. What happened is they quit too early. They didn't give compounding time to work. Let me give you a personal example. When I was young, I saved every dollar I could. I lived cheap, drove an old car, ate at home. My returns in those early years were negligible. A few hundred here, 1,000 there. It felt like nothing, but I kept going. I understood the math, even if I couldn't yet feel it. By the time I hit my 40s, something clicked. My capital was earning more than I could save. That's the tipping point. And you can't reach it if you quit in year 5. The ones who get rich aren't smarter than you. They just have a longer time horizon. They can tolerate the psychological discomfort of watching small numbers crawl. They don't need instant gratification. That patience is their competitive advantage. If you can develop it, you'll beat 90% of the population by default, because 90% of people will quit when it gets boring. Here's the test. Can you watch your capital earn $500 in a year and not spend it? Can you watch it earn $1,000 and reinvest it? Can you do that for 10 years without flinching? If yes, you'll probably get rich. If no, you'll stay broke. It's not complicated. It's just hard. Let me talk about lifestyle inflation, because this is the silent killer of wealth. You graduate, you get a job, you start earning $40,000 a year. You live on $40,000. Then you get a raise to $50,000. Do you save the extra 10? No. You move into a nicer apartment, you buy a better car, you eat out more. Now you're still living on $50,000 and you have nothing to show for the raise except higher monthly bills. This pattern repeats for decades. People earn more, they spend more, they never accumulate capital. I've seen lawyers making $300,000 a year who are broke. They have the big house, the expensive cars, the country club membership. From the outside, they look rich, but they're trapped. They can't afford to quit. They can't afford to take a risk. They're wage slaves in fancy suits. Wealth is built by keeping your lifestyle flat while your income rises. That gap between what you earn and what you spend is where capital comes from. If you close that gap, you're finished. It doesn't matter if you make $1 million a year. If you spend $1 million, you're no wealthier than the guy making $50,000 and spending $50,000. I lived through the Depression. I saw men in expensive suits standing in bread lines. You learn quickly that appearances are meaningless. It's the balance sheet that matters. And most people have terrible balance sheets because they confuse looking rich with being rich. They're not the same thing. Looking rich costs money. Being rich requires saving it. This is where inversion thinking helps again. Don't ask, what can I afford? Ask, what do I actually need? Most of what people buy is junk they don't need, purchased to impress people they don't like with money they don't have. Cut that out, and suddenly you have capital. It's not complicated. It's just psychologically difficult. Because humans are wired for status competition. You have to consciously override that wiring. I drove an old Volkswagen for years while I was building wealth. People thought I was cheap. I didn't care. I knew those car payments they were making were compounding in reverse. They were paying interest. I was earning it. 20 years later, I had capital. They had nothing. Who was smarter? Now let's talk about the moment capital starts talking back. This is the inflection point that changes everything. For years, you've been saving, grinding, watching small numbers crawl. Then one day you look at your balance. Your investments earned $15,000 this year, more than you could save. Your capital just outworked you. That's when you realize the game has flipped. From that point forward, the compounding accelerates. Your capital earns money. You reinvest those earnings. Now you're compounding returns on top of returns. The snowball doesn't just roll, it accelerates. And the psychological shift is profound. You stop feeling like a laborer and start feeling like an owner. You have options. You have freedom. You have leverage that no paycheck can provide. This is what I mean when I say the first 100,000 is critical. It's not about the number itself. It's about crossing the threshold where capital becomes self-sustaining. Before that point, you're pushing the boulder uphill. After it, gravity starts working with you. But you have to get there first. And most people never do because they lack the discipline to endure the uphill climb. Let me warn you about what happens next, because this is where a lot of people blow themselves up. They reach 100,000 or 200 and they think they're geniuses. They start taking risks they don't understand. They chase hot stocks, they leverage up, they get cocky, and the market humbles them. I've seen it 1,000 times. Overconfidence bias is one of the most dangerous psychological tendencies. You have a few wins, and you start believing you're smarter than you are. You forget that luck played a role. You forget that markets are cyclical. You start thinking the rules don't apply to you. That's when you get killed. The market doesn't care about your confidence. It cares about the math. And the math is unforgiving. I made this mistake in my 30s. I had some capital. I thought I understood a particular industry. I invested heavily. I was wrong. Not catastrophically wrong, but wrong enough to hurt. The lesson was invaluable. Stay humble. Stay within your circle of competence. And never forget that the market can stay irrational longer than you can stay solvent. The key to keeping wealth is the same as building it. Avoid stupidity. Don't speculate. Don't leverage. Don't panic sell. Don't chase fads. Just sit on good businesses, reinvest the dividends, and let time do the work. It's boring. It's unglamorous. But it works. And the older I get, the more I realize that boring and reliable beats exciting and risky every single time. Let me tell you about Charlie Darwin. He spent decades observing, cataloging, thinking. He wasn't in a hurry. He didn't publish until he had overwhelming evidence. He understood that patience and thoroughness beat speed and cleverness. That's how you should think about wealth. You're not day trading. You're not gambling. You're patiently building a position over decades. The compounding happens slowly, then all at once. Here's a mental model I use. I imagine my portfolio as a garden. I plant seeds, businesses I understand, with good economics. Then I water them, reinvest dividends. I pull weeds, sell obvious mistakes. But mostly I leave them alone. I don't dig them up every week to check the roots. I trust the process. Over years, the garden grows. That's compounding. That's wealth. The people who fail at this are the ones who can't stop themselves from digging up the garden. They trade constantly. They check prices hourly. They panic at every downturn. They're not investing. They're gambling and calling it investing. The emotional toll destroys them before the market does, because the emotional cost of volatility is higher than the financial cost. You can survive a 50% crash if you don't panic. You can't survive panicking. I lived through the 1,970 seconds, the stagflation, the malaise. I watched people lose their minds. Stocks went nowhere for a decade. Inflation ate purchasing power. Everyone said equities were dead. The smart money moved to gold, commodities, real estate, and the ones who just sat on good businesses. They did fine. Coca-Cola, See's Candies, Washington Post. They kept compounding. The businesses didn't care about the macroeconomy. They just kept selling products and returning capital. That's what ownership means. You're not trading pieces of paper. You're owning slices of businesses. And good businesses compound for decades regardless of what the market thinks. The market is just a voting machine in the short term. In the long term, it's a weighing machine. If you own quality and you're patient, you'll do fine. Let me give you a specific, concrete plan, because theory without practice is useless. Here's what you do if you want to build wealth, and you're starting from nothing. First, track every dollar you spend for 1 month, not because you're a masochist, because you need to see where your money is actually going. Most people have no idea. They bleed money on subscriptions, dining out, impulse purchases. Awareness is the first step. Second, cut the stupid stuff. You don't need 5 streaming services. You don't need a new car. You don't need to eat out 4 times a week. I'm not saying live like a monk. I'm saying be deliberate. Every dollar you spend is a vote for your future poverty. Every dollar you save is a vote for your future wealth. Vote wisely. Third, set up automatic transfers from your paycheck to a brokerage account. 10% minimum, 20% if you can stomach it. The money leaves before you see it. This removes willpower from the equation. You can't spend what you don't see. This one habit will do more for you